Good morning. Welcome back, everybody. Today, we're talking about the foundation to building a trading model. So, you have all this information you've been studying, watching videos on ICT's YouTube channel. How do you take all this information and build yourself a trading plan? How do you come to that conclusion where you have a structured model with set rules in place that you can go into the marketplace, take a position, manage that position, whatever the outcome might be, having everything written down. If this happens, this is the process that I follow. If that happens, then that is the process that I follow to manage that position. So, first things first, you've studied from ICT's YouTube channel. The first thing that a new trader or somebody that's relatively new, the first thing that you are going to focus on is going to be the price action. That's what you're going to be looking at. How to read the markets, what you're going to be looking for. We are primarily focusing on ICT concepts. So, ICT concepts in a general, a wonderful place to start if you're brand new and you're not sure where to start. 2022 ICT mentorship. It's a wonderful playlist to work through. It gives you a basic model that's easy to see, and he gives you a wonderful structure around that model as far as things you need to avoid, things that you need to look for that give your setups higher probability. The same thing can be seen in the 2023 mentorship, which is also a nice playlist to work through. And as we are closing off 2024, the 2024 mentorship would also be a viable playlist that you could work through. Now, keep in mind that if you choose 2022 mentorship, you watch all the videos, and of course, you have to journal with each video, and you have to go in and you need to practice the things that you have learned. Doesn't matter if you're journaling on paper, if you prefer to do that, or if you prefer journaling on something like Notion or any other software. That is completely up to you. Take your screenshots, pause the videos, take screenshots, put your notes on the screenshots, or put your notes above or beneath the screenshots so that you know when you're reading through your notes that you are referencing to that specific piece of information. Now, if you chose 2022, 2023, 2024, does not matter. But if you chose one, it's not necessary to study all of them. If I choose 2022, it's not necessary to go and study 2023. If I study 2022 and I find my niche and it all clicks and that makes sense to me, it's easy to see the fair value gap and that model resonates with you. There is no need to rush into 2023 to study that and apply its methodology. One thing that I have learned from ICT's concepts is that he has a plethora of concepts. He has a toolbox filled, overfilled with tools. Pick the tools you need for the job that you want to do. You do not necessarily need to have the whole toolbox. Having the whole toolbox, trying to apply everything, will cause you confusion. So start with one thing. If that's the fair value gap, then stick with the fair value gap if that resonates with you. If the fair value gap does not resonate with you, that does not mean that the 2022 mentorship is not going to work for you. You take the fair value gap and replace the fair value gap with something like a breaker block, or replace the fair value gap with something like an order block. You could even replace it with a inversion. So there is a plethora of entry models that could be applied using the 2022 mentorship's logic. So what you start with, that is completely up to you. But once you chose one, take the time, take a whole year, study the concepts, work your way through that mentorship, and everything that it gives you, practice it. Don't rush to get to the next video. Make sure that you understand what you've learned. Don't just watch the video and go on to the next one. That will not help you. So you start with price action. As you're working your way through the 2022 mentorship, things like risk management will be introduced to you. Things like psychology will come across your path as well. ICT talks about all these things in his mentorships. If you have a basic understanding of a mentorship that ICT provides, if you've gone through that, your next stop could be risk management. Now, risk management is very important in this business. It's about capital preservation that keeps you in the game so that you're able to come back tomorrow. If today was not a good day, you can come back, get back at it, and get to work. So, rule number one, capital preservation. Always know how much you're placing on the table beforehand. Now, Knowing how much you're placing on the table needs to be an amount that you're comfortable with, that if you're walking away for the day, even if you lost this amount of money, or you don't have this money back in your pocket, that it's not going to be something that you're going to be writing home about. You're going to take that loss. You're going home with that loss. You're not going to be worrying about it all the time. You're going to be coming back tomorrow and you're going to be applying the same concept, going back at it. So, this can either be a dollar amount or this can be a percentage amount of the total account value. Whatever you are comfortable with. And it's going to depend on how you approach it. Talking about percentages, it's always a good idea to risk half of a percent. Half of a percent on a setup with an account size of, let's say, 5K. So you're going to be trading, as per that example, you will be trading micros. So risk half a percent, and that gives you a plethora of setups that you can take. Keeps you in the game. And what you could do to keep yourself further in the game is, if you're going into drawdown, things like if you take 2 losses in a row, you cut that risk in half. So then we're going in, we're only taking a 0.25% of 1%. So you cut half a percent, cut it into half. So you're only taking 0.25% risk until you make, let's say, half of what you lost, until you make half of that back. And then you size it back up to a half percent. Doing so, if you go into a losing streak and you lose 10 trades in a row, it's not going to take you out of the game. You're not going to be closing the business. You're preserving capital. You're also preserving mental capital, because you're approaching this in a structured way. So you've got a plan laid out. Having a set plan laid out, that removes the emotion from the game. You're never looking at the outcome of every single trade that you take. You're looking at the outcome of a set of 10 trades or a set of 20 trades. Not one trade makes or breaks the game, doesn't close the business. You're looking at a span of setups, applying the same thing over and over again. So that's a little bit on how you could approach risk management. Now, another thing that we can look at is ICT 2016 Core Content Month 2, videos 1 through 6. Let's have a look at these here. 2016 ICT core content. There are some really valuable gems in here. The first video, ICT shows you how you could grow small accounts. And this is where he talks about risk, how applying proper risk management and compiling the effects over a period of time while taking losses, you still have a positive outcome. Month two, framing low risk trading setups, which is another good video to watch. Video number 3 is how traders make 10% a month. Nice little video to watch. 4, no fear of losing. Now, this is a gem. ICT goes in, it shows you how even if you take losses, again, coming back to risk management, like I explained, you could take losses and you still come out net positive for the month. You do not have to be 60% profitable to make money. You could be 30 or 40% profitable and you could still have a net positive outcome. Video number 5, how to mitigate losing trades. So in this video, ICT shows you how easy it is once you've taken losses, how you could make that back. And then finally, the 6th video, the secrets to selecting high reward setups, which is another good addition to watch. So 2016, these videos are still valid. Till today, the concepts and things that he talked about in these videos are still applicable. So I recommend you to go and give them a watch. Psychology. Trading is 20% pushing a button, 80% psychology. Knowing what days you're not going to be going in there. So, in other words, feeling comfortable not being in front of the charts, feeling comfortable with missing setups, knowing that they will repeat. Opening up a chart, sitting down, price action is not good for the day. Don't force yourself to sit in front of that price action as a stupid reference. Take a look at yesterday's price action on a 15-minute. Wasn't good. High resistance liquidity run conditions. I sat for 8:30, sat until 9:30. Price action was not clean. Closed it out. Stepped away, did something else. And price was not clean for the rest of that day. Didn't miss anything. If you force yourself to sit through those times and you're not careful, you don't know how to control yourself, you're going to end up in a trade because you're going to start to see things in the charts that are not there. And that'll cause you to take losses. And if you don't know how to control that, then you're going to go into a spin of losses. And then you end up blowing the account. So you have rules in place for the well being of your psychology. The calendar comes into play. Look at what days you have high or medium impact news drivers. That'll be volatility injections. Do you have a minefield of volatility for a certain week? Then that might not be a good week to be trading. Instead, do something else. You can plan ahead, folks. The calendar is planned out weeks ahead. You can plan out months ahead if you want to. Just by looking at the calendar, when will my favorite shows be up? Look at the calendar. Calendar shows you, it's a guideline. Of course, you need to know which events bring high resistance liquidity runs. So you need to know a little bit about the calendar. Where will you get that information? Go to 2022 or 2023 mentorship. Study them. If you sit 1 year and you follow the market for 1 year, only studying, looking at the calendar, observing things, taking notes, taking screenshots of that calendar, making notes, you will very quickly learn what days bring high volatility that are good to trade and which news events bring high volatility, but they bring high resistance liquidity runs. You want to be trading high resistance liquidity run, folks. Why do you want to be sitting there in give and take conditions when you could be going in when it's low resistance? You take your entry, right time of the day, and it runs like that. You're done. You close it off and you go on doing something else. Why do you want to be sitting there trying to force it? Again, identifying high resistance liquidity runs. If you sit there for a year and you study price, you watch these sessions, you tape read these sessions, you look at the calendar, you say, okay, we have FOMC. So I'm going to sit down and I'm going to tape read the morning session. I'm going to tape read the PM. And I'm going to see what does price action do? How does it behave? And that is how you learn. Another fantastic psychology tool. Look at the ICT 2022 Twitter Spaces. You can find them. You can find them on YouTube. You don't have to go back on Twitter. You can find. Now, I'm not talking about those 5 or 10 minute summed up. I'm not talking about TikTok mentality Twitter Spaces. I'm talking about the whole thing, the whole 3 or 4 hour thing. You can find them on YouTube. A lot of people have reposted them. You can find them and you sit down on a Saturday, maybe on a Sunday afternoon. You're not planning on doing much. maybe an afternoon or an evening, you don't have much planned, you can pause that thing. You can pause it and you can continue off on a different day and still pick up where you left off. And take a notepad or make sure that you have a Notion page set up so that you can take your notes with that Twitter space because you're going to get a lot of gems. If you sit through, if you listen to them, and ICT does focus on psychology in those Twitter spaces as well. Going back to risk management, he talks about things like that. So they are a gem. So if you've gone through price action, you've got an understanding of risk management, you've got an understanding of psychology, you've got written down rules in place, you can start focusing on a trading plan. So this is you taking all these things and you start bringing them together. So a trading plan, that is going to be a journaled trading plan. So it's going to be a plan that you have written down in your notes. And 2022 mentorship, 2023 mentorship, ICT gives you a basic foundation of a trading plan. Like I have said in previous videos, you need to take that trading plan and you have to add to it. A wonderful video on my channel is look at the Notion video that I posted. That is a basic idea how you could take a couple of things and get a trading plan. And you need to build on top of that and make it your own. As with everything else, you have to make it your own. If it's not your own, it's not going to work. So make it your own, take it, make it your own. And what you do with that written down trading plan, you back test. Go into the charts, back test for 3 months. Bare minimum 3 months. Go in, back test, and gather data, and do that for 3 months. If you did it for 3 months and you still feel like you want to practice more, then continue doing so. But do it for a minimum of 3 months. Then we get into tape reading. Now, the reason that I say tape reading is you're going to go on a live market and you're just going to see how many times that model plays out. You're going to see how many times does it play out on a live market. And you're going to do that for 3 to 6 months. Okay. If you do it for 5 months and you feel comfortable, or for 4 months and you feel comfortable, then you move on to forward testing. Forward testing is you going in and you placing a long or short position from trading view on to the trade idea that you see, and you watch if that idea plays out. If it does play out, you journal that setup, and any setups going back that you've missed during that week or that you did not see, you go back and you take screenshots of those and you put them in your journal. It's important to note things like, what was the stop if you took the entry? What was the take profit? How much time did it take to go to the take profit? What day of the week was it? What time was it? What news events were present on the calendar? What was the higher time frame doing? Did you have high resistance or low resistance conditions? Okay, so this is where you have that list in your journal and you're ticking things off. You're ticking things off and you're doing that with each setup. You're noting it down. You are collecting data. You are collecting very important data while you're doing that. And you're training your eye to see it over and over and over and over again. It's panning out, panning out, panning out, panning out, day after day, day after day. So that's adding to your psychology. It takes away that fear of missing out because it repeats on a weekly basis, daily basis. So that's very important. You do that for a minimum of 3 to 6 months. And then finally, you arrive at demo trading. You only go into demo trading if you feel ready to do so. The easiest way to see if you are ready to go into a demo and apply these concepts, you take an account, just like ICT told us to do in the 2022 mentorship. Take an account, take it into a simulated drawdown, and very important, take your time and make drawdown back plus a small profit. You're not rushing it. You're not taking these big sized lot trades. You're going in small, and you're taking trades, taking trades, taking trades casually. You're not rushing into it. You're not freaking out if you take a loss. You're going in slowly and you're gradually working the account back up. If you fail to take the account back up, and let's say a good starting point is taking a 50K and taking it into a 2K drawdown. So taking it into 58,000K, taking to 50, yeah, 48, not 58. Take it to 48K and start working the account back. Apply the model that you've practiced, that you've journaled, that you've backtested. It's proven itself that it works over and over and over again. Go look at the data that you've collected. Apply that. If you blow the account, if you go below the 48K, then you have to start over again. It's very important that you journal those trades, journal them, handle it like it would be a real account. Handle it like a real prop firm account. So you take it serious, you do your journaling, and you will see things that you have to work on. Things that you might have to go back on, and you might have to improve on those things or work on those things or get a better understanding of certain things if you blow that simulated demo account. So you're not going to be rushing in to reset the thing to do it again. Things are going to stand out and you're going to have to go back and maybe work on, let's say, once you're in a trade, you're able to hold the drawdown, but as soon as the trade goes into profit, you're just fiddling. You start freaking out a little bit and you just want to close. You just want to get out. You just want to take the money and get out. So you have to take a step back and you have to go and work on that. You have to press into that. You have to put limit orders on. So one solution to that problem would be you have a hard set stop and you have a hard set take profit. And come hell or high water, price is either hitting the take profit or it's hitting the stop. So you go and write down, okay, my stop loss is going to be 10 handles. My take profit is going to be 10 handles. I can only move the stop loss once price has traded and closed below a short-term low. This is if you're taking a short, by the way. I can then move my stop to cover the fees and commissions that would be present. But I then need to let price do its thing to hit the break even or hit the take profit. And that is a hard set rule. and you stick by that rule and you press into the uncomfort. You read the price action, read the candlesticks, look at what they're doing. Is price leaving gaps open, pushing lower? Or are the candlesticks overlapping? And does it look like price doesn't really want to move? And price is telling you the story by doing those things. If you are able to take that account from a drawdown into a profit, you will see a lot of your flaws will be pointed out. You then go back to those flaws, you work on the things that you need to give attention to. You then do another simulated demo account with a drawdown, and you take it back into a profit. And once you've done that, and once you feel comfortable with yourself, then and only then do you make the decision to take what you have learned and put money behind it. Nobody can tell you to do that. Nobody. That is something that you do yourself. And you will know when you feel ready. Now, if we move down here, adding to risk management, let's look at win rate. Risk to reward. So let's say over 100 trades, okay, 100 trades, and you start with a, let's say a 1-to-1. You start with a 1-to-1 and you are 55% profitable. Over the course of 100 trades, you would have made 10% on the account. And a lot of you people are going to think that that's not a lot of money, that it's minute. But the bigger your accounts start to get, things start to compound. If you, for instance, take a account that is, well, let's just say you take a, let's see, let's say you take a $50,000 account, you compile 10% on that, and that is $5,000 of profit, which doesn't seem like a lot. But again, compounding effect, as your money grows and you do more prop challenges, or you've got a real account with real money, you have $100,000 in there, 10%, $10,000. $10,000 that you did not have, people. If you can do a 1-to-1 consistently, you can start going for 1-to-1.5. Look at the compounding effect here. If you can do 1-to-1.5 over the course of 100 trades, you are 55% profitable. That gives you 38% of the account. So let's go back to that simulated 50 50K account, or let's say that you have a 50K account. 38% of that 50K account is $19,000. See the compounding effect here? $100,000, you get $38,000 return on the investment. And shooting for 1 to 1.5, notice that now, if you are 45% profitable, you make 13% return. Looking at 1 to 2, 35% profitable and you make 5% on the account. 40% profitable, you make 20% on the account. It starts adding up real quick, doesn't it? 40%, $100,000 account, 20% on the account, you're looking at $20,000. Take $5,000, $50,000, so we're looking at $10,000. If you are 50% profitable, even 45% gives you 35% return on that investment. Math starts adding up. 50K, that's $17,500. 100K, $35,000. And 50K is 17.5. For a moment, I thought that I was incorrect there. So see how the numbers start to add up? So if you're 50% profitable, you make half of that account. So 50K, 50% profitable, it's 25K people. That's a lot of money that could pay a couple of bills, that could go into savings, and you could be living a comfortable life. And you're 50% profitable. That is not a lot, people. You're not shooting for 70%. You're just 50% profitable or 45% profitable, and you are making a killing. Come on! Why is nobody excited about that? Everybody wants to be the best. Everybody wants to be in the top 20%. Gotta have that 70%. Gotta have that 80%. Not really. If you have 45% and you could do a 1 to 2, 35%, that is a lot of money. And you should be excited about that. That's going to take a lot of weight off of your shoulders. Just imagine having that extra money, being able to pay the bills comfortably, being able to buy enough food, not having to worry about that. And you know what? If you can go out and you can help somebody, just one person, and you can pay their grocery bill for them just randomly. You're just walking into a shopping center, just randomly, just walk up to somebody and say, "I am paying for your bill today." Just imagine that you're helping somebody who you don't know what their situation might be. They might really be in a bad situation where they might not know what they're gonna do tomorrow after they've eaten finished all the food, and they might not have money to be able to go back and buy more food, at least until the end of the month. So they might have to swing it for 2 weeks, and it might be hard for them. Just imagine being able to give back. Just think about it, folks. So coming back to it, that is how you piece this stuff together. How you come into a model, how you take that model, and how you test that model to see what things do I want to add to the model. Well, you're going to see that during the back testing and the tape reading. You're going to see, okay, well, I want to add this, or maybe I want to add a different data point. You're collecting data. That's all you're doing. You're collecting data. You're proving to yourself that it works day in, day out. You're seeing, is my stop applicable? When the setup pans out, is the stop applicable? Do I need to increase the size of the stop? Am I able to decrease the stop a bit? Well, you'll get your answer when you're back testing. When you're forward testing and tape reading, the data will tell you what you need to do or what you can do or cannot do. That's what it comes down to. Everybody's out there talking about this wonderful model and that model and oh, this new model or this new concept. You don't really need any new concepts. If you have a fair value gap, or if you are somebody that loves to trade the Fibonacci and you are trading the OTE of the Fib, if that works for you, you don't need anything else. You don't need a Reaper. You don't need the consequent encroachment of the wick. You already have something that works. ICT talks about this stuff all the time. He says a lot of his old students, they don't care about the new stuff because they have something that works. And they couldn't be any less worried about new things being released because they have something that works for them. And they're not changing it. They're not looking to get on the new thing every week. And yes, there will be times that your model will not pan out. There will be times where you will take losses, but it all comes back down to the risk management. If you're managing the risk correctly, then those losses are minute because you will be coming back into the game. Your model will present itself, it will pan out. Everything is in place, and you will make back that drawdown. You follow the rules. Another way how you get your strike rate higher is everybody's, when do I need to get in? When do I need to get in? How can I get in? When do I not have to be there? What about that? When can I go do something else for the day? When do I not push the button? When is it a low probability for me to get in there? If you focus on those things and you reduce the frequency of trading, but you focus on taking higher quality setups, your win rate's going to go up because you're reducing the frequency, but you're looking for really good setups. That increases your win rate quite substantially. And it's also good for your psychology as well as risk management because you're not going in there trying to push a button on every single thing. You're only going in there when it's a good probability for that setup to form, when all the things are in place supporting that idea. So that's really important. When to stay out. That is very important. That's capital preservation, guys. You're preserving capital. So hopefully this video helps you to piece together some of the concepts or ideas that you've learned, not just from ICT, but maybe from other traders as well. And remember, you don't need every single tool. If you have something that works, stick to that. And with that said, good luck and stay well.